The broadcast is now starting. All attendees are in listen-only mode.
Hi, everybody. Welcome to our webinar, Gifting for Good, End of Year Tax Tips, presented by WP alumna Maria Rollins, class of 91. My name is Sharon Ryan, and I am the Assistant Director in the Alumni Relations Office at William Patterson. Also in attendance is our colleague, Judy Linder, from the Office of Institutional Advancement here at William Patterson University. In this second webinar in the Gifting for Good series, you will learn how to get more control of your money, get more income, subsequently and more joy and less tax. Your gift can not only help you financially, but can impact students at William Patterson University. Topics to be covered in this webinar will include required minimum distribution tax strategies, gifting through donor-advised funds, and tips to reduce taxable income in light of the Medicare surcharge. Before I introduce today's presenter, I'd like to go over how this webinar will work. First of all, you should be able to see the presentation right now on your screen. You also should be able to hear me on your computer's audio system. Please feel free to ask questions by typing them in. We will be monitoring your questions and will answer them at the end of the webinar. Any questions that are not answered in today's webinar will be addressed after the webinar is completed. You will be getting a short survey at the end, and there'll be a room for you to type a question in, and our presenter will be happy to address those questions. So now I would like to introduce today's topic and speaker. Maria Rollins, CPA and WP Class of 91, is the Managing Partner for KRS CPAs, responsible for guiding the growth and governance of the firm. She spearheads the successful business development team, business insights breakfasts, and marketing efforts, and leads practice management and staff selection and development. Maria also manages the firm's tax practice and spearheads the handling of regulatory and compliance matters arising from state, federal, and industry oversight. With 20-plus years of public accounting experience, Maria brings her clients extensive knowledge in the complex art of tax planning and compliance. Maria also specializes in family-owned and international companies and startups. Maria graduated from William Patterson University with a Bachelor of Arts in Accounting and received her Master's of Science in Taxation from Fairleigh Dickinson University. She is a member of the American Institute of Certified Public Accountants and the New York and New Jersey Societies of Certified Public Accountants. She is a member of the NJSCPA State Tax, IRS Cooperation, and Estate Tax Committees. Maria has also served on the board of directors for various business organizations. In today's webinar, Maria will provide tax tips and answer your questions regarding gifting for good in anticipation of the calendar year end. And now I would like to introduce our presenter, Maria Rollins. Maria?
Thank you, Sharon, for that wonderful introduction. You covered just about everything that I have in my first slide here, other than me mentioning that I am born and raised Bergen County native, currently living in Bergen County, Paramus, New Jersey, with my husband, 2 sons, and my 2 rescue dogs. You can see a picture of my doggies there. I guess I had to throw that in there. We're going to talk about some interesting tax topics, so everyone likes to see a little doggy before we get going there. Thank you, Judy. Okay, so what we're going to cover today, we'll get right into it. I want to talk a little bit about the changes under the TCJA that went into effect back in 2018, and we all lived through a year of those filings. I would then we'll talk a little bit about strategies to reduce income taxes. We'll talk about gifting with the required minimum distributions. Talk a little bit about gift bunching, and I'll show you some examples through the use of donor advised funds. They've been around for a while, and we're seeing more of a comeback with those types of funds. Talk a little bit about gifting with appreciated stock with an example, and a topic that seems to be very much of interest with my clients now is the Medicare surcharge and strategies to reduce taxable income. And then we'll talk a little bit about charitable gift annuities. So hopefully we'll be able to cover all of that, and we'll get everybody finished and on with their day by 1:30. Okay. So let's talk a little bit about the current landscape after the Tax Cuts and Jobs Act. So we probably all know now we lived with a filing under the new tax law for 2018. Some were pleasantly surprised. Some were very unpleasantly surprised. And hopefully by now, with 2019, you worked out any kinks and you're ready for your year-end and tax filing in April. So where we stand right now is an increased standard deduction. So as the slide says, married filing joint is $24,400 and $12,200 for married separately, $18,350 for head of household, and $12,200 for single. And then there's an additional $1,300 for those 65 or older or blind. So what we're seeing now in our practice is quite a few more people taking standard deductions rather than itemizing. And that is in part by those increased rates for the standard deduction, coupled with the fact that we're limited to state and local income tax deductions on our Schedule A of $10,000. Now, you live in New Jersey, everyone knows that our state and local taxes are very much more than $10,000, but that's what we're currently limited to, and we're working through that. New for 2019 is the floor for medical and dental expenses. In the past, it was 7.5% of adjusted gross income before you could even get a benefit of any dollar of medical deduction. That's going to be raised to 10% for 2019. We all know by now that miscellaneous deductions are no longer deductible, so our fees for our brokerage accounts, employee business expenses, those type of deductions are no longer deductible as an itemized deduction. And then the other point worth mentioning is the percentage limit for charitable deductions. Those are now 60% to public charities, 60% of AGI. So that being said, let's get right into our first example. So sticking with the holiday theme, I guess, is Mary and Joe live in New Jersey. They pay $15,000 in real estate taxes. They have no mortgage. They're both retired and they have pension income. They're collecting Social Security, and included in their income is Joe's RMD of $50,000. And they consistently donate $15,000 per year. So we're going to walk through an income tax example with no planning. So very simple, total income is $233,948. They have charitable contributions of 15. There's their taxes, although they're 18, and that is just limited to 10,000. We have total itemized deductions of 25,000. With the new standard deductions and their age, they have a standard deduction of 27,000. The standard deduction is higher, so that's what they'll take, and their taxable income is 206,000, and their tax is 36,350. So you'll see that there's no benefit of that charitable contribution because their standard deduction is higher than their itemized deduction. So with just a little bit of planning, and it'll be our first concept that we'll talk about, no observations here. No benefit for the donation, and the Joe's 50,000 RMD is taxed at 24% marginal federal tax rate. So with a little bit of planning, Joe and Mary tuned into our webinar today, and they learned that if you are age 70 and a half or older by the end of the year, and you have traditional IRAs, and particularly if you can't itemize your deductions, you should consider making 2019 charitable donations via charitable distributions from your IRA. So those distributions are made directly to the charity from the IRA, and the amount of the contribution is neither included in gross income nor deductible on Schedule A 1040. So the RMD is not included in income, and you do not get an offsetting charitable deduction for it. But the amount of the donation of the distribution does go against your required minimum distribution. And that in itself could help you reduce the tax savings. So let's look at an example of the comparison. So with very little effort, we've saved $3,600 in federal taxes just by having And we're talking talking $15,000. So, we're only talking about $15,000 on the donation here, but just that little bit of planning, make the phone call, have the distribution come out of the RMD, we've saved $3,600 in federal taxes. And again, you'll see that there's no change to the total deductions because we still are taking that $27,000 standard deduction. So again, very little effort, tax with no planning, $36,350, tax with very little minimal planning, $32,750. And these are small numbers. As you can imagine, when you're working with RMDs, the numbers can get quite large, and depending on how charitable you are, you'll have the benefit or the option to really defer that income up to $100,000 per person. And I'll talk a little bit about the rules for RMDs. So the rules for RMDs, 70 and a half, you need to begin taking out from the IRA accounts. Withdrawals are taxed at ordinary income rates. If you don't take the RMD, you will get hit with a 50% penalty. And if you want the qualified charitable distribution to satisfy the requirement, you'll need to transfer those funds from the IRA before the end of the year, directly from the retirement account to the charity, and there's a $100,000 limit per person. So in practice, we're seeing quite a lot of this in practice. We have clients that are very charitable, and we'll do some tax planning this time of year. We'll find out what the best planning point is for them, and we'll make these transfers prior to year end, and we'll reduce taxable income appropriately. So it's a great thing to consider. The next point that we'll talk about a little bit is the donor advised funds. So last year, when we were doing tax planning for 2018, and we had a lot of clients that were not getting any benefit from their charitable deductions, we, as a firm, looked into planning for those clients, and we had quite a few that decided to go with the donor advised funds route. Now, for this to benefit, we looked at clients that were consistently charitable. So we had clients that had charitable commitments with certain charities over a 3-year or 5-year period, and they were consistent, but perhaps no mortgage. Even not even New Jersey. They could have even been in another state with very low state taxes. No advantage to itemize. So what we found here is that by bunching their charity, so if I have a commitment on a 3-year period, I bunched it all into this year, I brought myself up above the standard deduction limit, I would have a benefit for the charitable deduction. So we saw a little resurgence here in donor advised funds. And by using these funds, you can advise a charity in future years as to the possible use of the donated funds and receive a charitable deduction in the current year when the funds are paid to the charity. The charity must fully own the funds and have ultimate control over their distribution. And you must get a written acknowledgement from the sponsoring organization. Now, the donor can advise the charity, which, from what I understand, they generally will follow recommendations, but the donor cannot have any power over the use of the distributees or the timing of the amounts. The donor's only input is to advise the charity to the identity of possible distributees and the possible timing and amounts of the distributions. So I recall a client of mine that had come in with some stock options that they were converting. The income was very high. He was consistently charitable, and he went the donor advised funds route, launched some charities. I think it was wound up being about a $50,000 donation in the current year, where he recognized the income, took that deduction this year, and it benefited him, and it satisfied his commitment over the next 3 years. So it's something to consider, and we'll jump into an example of a donor advised fund. So Mary and Joe, they're both 70. All other facts are the same, except they're not yet required to take RMDs, All of their other income is from pension accounts, and they donate consistently $15,000 per year to their favorite university. Mary and Joe decide to bunch the next 3 years of donations by using the donor advised funds for a total of $45,000. Now, if you look at the comparison, and these are all the same facts, I'm using the same example, and again, the numbers are small. You can imagine how to multiply this if the numbers were much larger. But using a donor advised fund and bunching 3 years worth of same $15,000 donation will result in an immediate tax savings of $6,561. Assuming that everything else stays the same, it's not going to impact their standard deduction in the next 3 years because they're not going to itemize. They'll take that standard. So it has no impact on those future years. So it's a way to just get that bang for that buck and also, satisfy your gifting levels. So if you look, the charitable contributions are $45,000 as opposed to the $15,000, and our taxable income is now $178,900 as opposed to $206,000. So our tax bill went from $36,150 to $29,589. So I don't know. In my book, $6,500 is real money, and if you do have the cash flow that you can bunch those deductions and get the benefit of it, it's something that I've recommended and that clients have been receptive to. I want to talk a little bit about gifts of appreciated stock. I didn't want to. It wasn't in our list of items that went out when we sent out the information here, but this is something that we see quite a lot of, where you have a very low basis stock, perhaps purchased long ago, and if you cashed in that stock, you'd have a capital gain, and you would be taxed on the capital gain in the current year. And one of the things that you can do to avoid the recognition of the capital gain is to donate that stock. When you donate that stock, you have a deduction for the fair market value of the donated property. You don't have to include the gain in income. And on top of that, so you avoid the income and you get the tax deduction for the charitable donation. So what I did here was I said, let's take Mary and Joe's situation here and assume that they, instead of donating $15,000 of cash, they donated $15,000 of stock that had only $2,000 of basis. That would result in a realized gain of $13,000 had they cashed it in and paid the tax on it. So if you look at the next example, the first column is the same example that we've been following that shows you the capital gains of $15,000. If you look at their capital gains in the planning model, it's $2,111. So that $13,000 of capital gain is removed. Everything else is the same. The charitable is the same. We're still taking a standard deduction. So this just shows you, and again, the numbers are small, that by donating that same $15,000 in the form of appreciated stock would result in a federal tax savings of $1,950. So the interesting thing about this is, depending on your income level, there's a surtax of 3.8% on investment income. So not only do you save yourself the capital gains tax if it's long-term capital gain of 20%, but depending on your income, you can actually save yourself the investment tax too. So we see quite a lot of this type of gifting in the tax clients that we represent here at the firm. Okay, what do I have now? Okay, so I'm going like really, really fast here. So I hope there's a lot of questions building up. It's just my New Jersey native in me that I speak very quickly. Yeah, okay, good. So let's talk a little bit about the Medicare surcharge. So in my tax practice, I do have quite a few individuals that are approaching their required minimum distribution ages, that are approaching retirement. They, have either their own businesses or they work for organizations and they have stock options and they need planning around the liquidation of those accounts. So we do come into quite a range of sophisticated tax planning needs. And what we're seeing more and more common now are hand in hand with the tax planning needs, the awareness of the Medicare surcharge. The more income I have, the more premium that I'm going to have to pay towards that surcharge. So it's something that we're paying more attention to as we go through these tax planning options. So if you're lucky enough to be qualifying and in the Medicare system, you probably already know that higher income beneficiaries will pay a higher premium for their Part B and prescription drug coverage. Part B helps pay for the doctor's services and outpatient care, and it covers other medical services such as physical and occupational therapy. If you're a higher income beneficiary, you'll pay a larger percentage of the total cost. So those percentages can go up to the premiums to equal 35, 50, 65, 80, or 85% of the total cost, depending upon what you report in your tax return. So they're about 2 years behind on tax return. So I want to say 17 will be what they'll be looking back on for the 19 premium charges. It also applies to the Medicare prescription drug coverage that pays for your prescription drugs. So again, if you're in a higher income bracket, you're going to pay more towards that coverage. Now, it's based on a modified adjusted gross income. And if you're married filing joint, that's going to kick in at incomes greater than 170,000. And if you file single, it'll be at 85,000. And above those numbers, you're going to pay more than the standard premium. So have some charts here. I should mention this. So normally the Medicare Part B premiums and the income related monthly adjustment amount, the surcharges are deducted directly from the Social Security benefits, and that result in a smaller net Social Security benefit. People who are not yet collecting or not yet claiming Social Security, they'll be billed directly by Medicare for the surcharge, for the premium. So here is the premium tables with the income limits of when these premiums kick in. So if you're $85,000 or less single, if you're $170,000 or less married joint, and $85,000 less married separate, the premium and the surcharge adjustment is going to be $135.50. And you can see by looking at the table, it goes all the way up to a new tier now of $750,000, where you're going to pay $460 per month per person in the surcharge premium. And I tell you now, living where we're living, we're seeing a lot of individuals subject to these additional premiums. Here's the 2020 brackets. They're going to be actually indexed for inflation. You can see those numbers have changed now. It'll be once or less. That last tier bracket of 750 remains unchanged. So depending on when your income level is going to fall in these brackets, you'll be charged a premium on the Medicare surcharge. So a lot of tax planning, as you can imagine, will go around planning for reducing your taxable income to fall in a lower tax rate bracket for the premium. Modified adjusted gross income, for this purpose, primarily you add back your tax exempt income, you add back U.S. savings bonds income. That's pretty much going to be how you're going to come up with your modified adjusted gross income. What's not taxable in modified adjusted gross income are distributions from Roth IRAs and Roth 401ks, distributions from health savings accounts that are used to pay for qualified medical expenses, and distributions from loans and loans from cash value insurance, proceeds from reverse mortgages, and we spoke about already, direct qualified charitable distributions. So if you're looking to reduce your taxable income and you're looking at these brackets and you have the option to work with some of these non-taxable items here, you could wind up saving on these premiums just by doing a little bit of tax planning, checking in with your, with your tax preparer, and putting a strategy in place using and just being aware of those brackets. So what we look at here, and it goes hand in hand with really any type of tax planning, is the ability to accelerate income into a low income year or to defer income from a high income year. So this time of year, if I wanted to accelerate income and I had the option, if I was working, say, with a business owner, and I could accelerate income into this year, we would have those conversations to do so. Maybe pay a bonus or recognize a sale or something to get that income into the current year. To defer income, if you're working with a business owner, we would talk about maybe paying expenses in the current year to defer that income into the following year. If you're not participating in Medicare as of yet, another strategy is to consider a Roth IRA conversion strategy. And you have to be careful with the Roth IRA conversion strategies, because when you convert from a traditional to a Roth IRA, the Roth IRA, that conversion amount is included in current taxable income. So the difference between the two, a traditional IRA, you're taking a tax deduction at the time that you're contributing into that IRA account. A Roth IRA, there's no tax deduction at the time that you contribute. So when you distribute from a traditional IRA, you've got a tax deduction when you put it in. When you distribute, you're going to pay taxes when you take it out. On a Roth IRA, since you had no tax deductions on the way in, it's going to come out tax-free. So if you're not yet participating in Medicare and you're not yet concerned about those brackets, and you perhaps are in a lower tax year or a lower income year, you can consider these Roth IRA conversion strategies. I have a client now that both are retired, husband and wife, both are retired. They are receiving pensions. This will be the first year, this will be the first low income year, considerable, compared to what they had before. And we are considering some Roth conversions now so that we could plan for the future to have those amounts come out of those Roth accounts as and not be taxable, not be included in income. So it's something to consider. It is a double-edged sword, though, because you will include it in income in the year of a conversion, but it's something that shouldn't be ignored, and it should be considered. The other is the use of the qualified charitable distribution. We talked about that earlier. You have to take that RMD out. That required distribution has to come out. It's going to be included in your income. If you're going to make the charitable contribution anyway, it's silly not to just have it transferred right over, keep it out of taxable income, and satisfy the RMD requirement. The other interesting planning tool is the HSA account. So that's the health savings account. So health savings accounts, they work like traditional IRAs, where you can get a deduction when you fund them. But if you use the health savings account for qualified medical expenses, the distributions come out tax-free. And you don't have to use the account in full in any given year. So that you can have the account that can grow a balance and then use those distributions for future medical expenses. And they'll come out of that account tax-free. So that's interesting. If you have the ability to fund an HSA, it's something that I would recommend to do. And then the other way to just avoid to defer taxable income or to avoid it in the current year, and if you need the actual funds, you can look to a home equity line or to borrow against a cash value or life insurance policy. So these are all measures just to look at your gross income, your total income, and ways to either defer that income or to just be mindful of these different brackets and do some planning to keep your income, within a lower bracket and save on the surcharge. So this next example here is Mary and Joe with the ultimate planning here. They decide to contribute the entire $50,000 of their RMD to their favorite university.
Could it be William Patterson?
I would think it is. They also decide to gift the $15,000 of stock with 2,000 bases. So right off the bat, we're not going to recognize $50,000 of the RMD in income. We're not going to recognize $13,000 of capital gain in income. And those two methods right there would produce a tax savings of $13,351. By doing so, it also reduces their modified adjusted gross income by $63,000, and then that would result in a Medicare surcharge savings of about $1,935. So, with some planning, and it's not terribly difficult planning, you can be on a schedule of small tax saving measures that can add up over the course of the year. And then again, if the numbers are very large, if you're taking advantage of the 100,000 and you're married and joint, and you can take advantage of a 200,000 RMD donation, then you'd really see some serious tax savings. So if you are hit with a surcharge, I had a client this year that retirement age, owned a business, owned a building, was actually real estate, sold the building, did a deferred like-kind exchange on the sale of the building for a portion of their sale. It was very good tax planning. Tax planning is only as good as the economics allow the person to follow through with. So we sold a building, recognized it was probably about $800,000 or $900,000 in capital gain, did a like-kind exchange to defer a portion of it and recognize a portion of it. So they had an event in their life, and I would call that a life-changing event because it doesn't happen every day. They only own one building, and it impacted their taxable income. They were hit with the surcharge, and not only were they hit with the surcharge, they had to pay it back for the months that they were getting their regular Social Security. And then we were all ready to file the next year return and have the surcharge removed, and the sale and the deferred like-kind exchange kind of wrapped into 2 different years. They couldn't do the like-kind exchange. They decided that they couldn't find replacement property, and it wasn't going to work for them. So we had to recognize, so we had a high year, low year, high year, unfortunately now, so they're going to be dealing with the surcharge now for another couple of years. And they're on a fixed income now, and they're living off of retirement income. So it's something that, whenever you're living off retirement income, you try to plan and schedule your monthly payments. So that was unfortunately would have been very good planning, but their life events changed and they couldn't go through with that. So you can appeal the surcharge. Unfortunately, my example is not a life-changing event in the eyes of the the greater people that be there. A life-changing event that caused income to decrease is what you would be able to appeal. So if you can, or you can prove that the income information that was used to determine the surcharge premium is incorrect or outdated. So a life-changing event would be a death of a spouse, marriage, divorce, annulment, retirement or reduced work hours for one or both spouses, loss of income producing property, or loss of a pension. So if you have those life events happening, you don't have to wait to file your tax return and wait for the calculation to catch up. You could file an appeal and have the surcharge reduced ahead of time. So the last point there is that one-time boost in income as a result of a sale of a vacation home, large portfolio. distribution, Roth IRA conversion, none of that's going to qualify as a life-changing event. So it's going to be something that, that you lost income, not in, the good grace that you actually had a good windfall year. Yeah, it's unfortunate that too. So now we're going to talk about your favorite topic, charitable gift annuities.
That's
and that's
right.
Judy.
So at William Patterson, we do offer our alumni and friends with the opportunity to engage in a charitable gift annuity. It is an option that we like to say is win-win. The minimum gift necessary to fund a gift annuity is $10,000, and at least one of the beneficiaries must be 50 years of age when the payments begin, and a maximum of 2 lives can be covered. We like to say it's a win-win gifting opportunity because with a initial gift of a minimum of $10,000, based on a metrics that is created by the ACGA, the American Council on Gift Annuities, there is a percentage that is affixed to one's age at the time of the gift. And while the university receives the full $10,000, let's say, gift, the donor would receive annual payments, annual distributions, and the university would issue those. We issue our charitable gift annuities on a quarterly basis, and donors have the guarantee of a steady income for the rest of their lives. It is interesting to note that on January 1st, the ACGA will lower the percentage payout rates by 3 to 5% based on annuitants' ages, and the payout actually represents about $30 to $50 on a $10,000 charitable gift annuity.
I could talk a little bit about basically overall what and how they work.
Okay.
And then,
Thank you very much.
Yeah.
Okay.
So how they work, as Judy mentioned, they provide a fixed income stream for the annuity period, and you also have the ability to make a gift to a charitable organization and receive a charitable deduction for the gift. So yeah, it combines the benefit of an immediate income tax deduction and a lifetime income stream. So the basic premise is the charitable gift annuity is that the donor makes a gift of cash or other property to a charity in exchange for an annual annuity to an individual for the remainder of the individual's life. So that could be a gift, it could be stock, it could be other property. It doesn't have to be just a cash donation. The donor does not have to be the annuity recipient. If the donor is not the annuity recipient, there could be some gift tax issues. So you have to make sure that you're looking at gifting, but it could be something that you're doing in the whole estate gift planning overview. Upon the annuitant's death, the charity may apply the remaining property to its general use unless there's an agreement that designates a specific purpose. So charitable gift annuities are similar to buying an annuity in the commercial marketplace. The only difference is you get an immediate tax deduction for the charitable piece of that. And that is based on IRS tables. You are looking at IRS tables, you're looking at rate tables. The charity must receive 10% of the initial net value of the property transferred in order to claim the charitable deduction for the portion of the purchase price. A portion of each annuity payment is tax-free because you're entitled to recover your original investment over your life expectancy. Right? So you didn't know that, right? So you have basis when you purchase the annuity, you actually have basis in the contract. So part of it is tax-free. And depending on what the asset is, if it's a capital asset, you could actually have some capital gain, which is a lower rate than ordinary rates, and ordinary income, depending on what the asset is. With proper planning, it's possible for you to claim a charitable deduction when you're in a higher tax bracket and then receive the annuity income when you're in a lower tax bracket. So that's always very good tax planning is to receive income when it's going to be taxed at a lower rate. The amount of your charitable deduction is going to depend on a combination of your age and the IRS rates of interest at the time of your purchase. Your charitable deduction, of course, will be less than the total value of your annuity purchase price because your deduction can only be claimed for the present value of the property that the charity will keep after your death, based on your life expectancy. So there are calculations that are going to go into the calculation of that deduction. Charitable gift annuity rates may vary from charity to charity. They're based on several factors, including the amount of the gift, as well as your age at the time of the gift. Younger donors may often see significantly lower rates because their life expectancy is much longer. So to illustrate, a 60-year-old who donates $10,000 may receive a rate of 4.4%, paying $440 annually, while an 85-year-old will see a rate of 7.8%, paying $780 annually for the same gift. You may see higher rates for donors who agree to wait a number of years before starting to receive payments. I don't know if you're seeing that, where I buy the contract, defer my payment a little bit, and I'll have a higher rate. And again, I can defer that payment into a year that I have lower taxable income. Rates are lower compared to traditional non-charitable annuities because the primary purpose here is a charitable gift that is going to benefit the charity. So it's understandable. Here's some information about William Patterson's program. You transfer cash, as Judy said, or the property to William Patterson, and the university agrees to make payments for the life, and it's backed by the entire assets of the university. At the end, the balance would transfer to the university. So I have information there for William Patterson. I know Judy, and I'm going to have a slide with Judy's information. Two, here's Judy, here's what you were talking about, how the new rates are coming in. Rates will decrease for all the age levels for both single life and two life charitable gift annuities. And that decrease is going to be anywhere from 0.3% to 0.5%. And there's a table that is included to show you that. So the benefits of the charitable gift annuity, if you do it before January 1st, you'll lock in the current higher rates. You'll, of course, receive satisfaction for making a meaningful gift. You'll have that security of the guaranteed income payments for life, and you will have some relief from taxes.
Sure.
On the bottom of that screen there is Judy's contact information. If you're interested in reaching out to Judy, is that the best way to do it? I have your telephone number
Yes.
and I have your email address. Okay, good. And that's it. That was quick. That went fast.
That was very good. I have one question. If anyone has any questions, you can type them in now. There's one here. Can you go back to the, can you go back on your slides to the charitable gift annuities? Is it possible?
I could. Charitable gift annuities.
The question just is, what would be, you're saying the lower rate and the higher rate, what do you, I know you can't recommend, I'm going to say, but what do you think is better to do? Is it better to start younger or wait, or this is the question that's coming in?
Well, you know what?
Really recommend, you know?
Yeah, well, you know what? I try not to do any kind of tax planning in a vacuum. So when I have a question like that, I like to sit down and say, okay, well, what is your overall gifting strategy? What type of income stream do you need for life? Where are you in your path to retirement? So it all goes hand in hand. I don't, in a vacuum, I wouldn't make any recommendation one way or the other. It really becomes part of a projection and a multiple year projection, and there's goals. I mean, you have life goals, you have gifting goals, there's estate planning goals, there's family goals. So my recommendation is to sit down with someone, CPA, financial advisor, ideally both, because the CPA will give you the tax benefits, and the financial advisor will help you with your needs, your financial needs.
Okay.
That's a great answer, Maria.
Yeah, I know it's very very general question, but you'd have to look at the individual and see, what their needs are. So.
Well, yeah, I mean, gifting itself is such an individual thing. I mean, we have gifting needs, and we also have tax saving needs. And I always tell my clients, sometimes, you have to look at the economics. You can't simply look at reducing taxes. You can't look at it in a vacuum. You have to look at economics of a deal, and you can't let the tax tail wag the dog, and that really is it. And when you're looking at retirement income and living on a fixed income, and what your retirement assets are, and how long that the expectation is, like, what is your life expectancy, and what are your needs, what are your spending needs, what kind of lifestyle do you want to have in those retirement years? Do you want to travel? Are you not a big traveler? All those kind of questions come into, the planning of and when you're dealing with an annuity, part of the annuity, look, the overall purpose of a charitable gift annuity is to benefit the charity. You're making a charitable donation. If your goal is to get, more of an income stream, it's a different goal than supporting a charity. So I wouldn't answer that question. I'm sorry that I can't answer that question.
No, you answered it perfectly. It's just, so thank you. If anyone has any questions, you can type them in, but if you can go to the end of the presentation too, just so we can have your contact information. And I don't know if Judy's is on the same page, but, oh yes, great. So if you have a question, and there's a lot of information presented here today, so if anyone has a question that they are like mulling over, you can contact Maria. Here's her email and her phone, and Judy's also email and phone number if you have any questions. I don't want to because sometimes people get put on the spot here, and I know they may have individual questions to ask you. Would you be okay with that, Maria?
Yeah, absolutely. We covered some topics here. The overall premise was to, help reduce taxable income while making some charitable donations. So absolutely, I understand that, there may be facts of a particular situation or just some clarification, and you can reach out to me. That's no problem at all. Judy did want me to mention that there is, you can go to the website, wpunj.giftplans.org for more information.
Yes, about charitable giving at William Patterson.
Gift plans?
wpunj.giftplans.org.
Okay. All right. Well, I want to thank you. If anyone, once again, everyone on here will be getting, there's a lot of information covered in this. So you're all going to be getting a little survey at the end that will pop up. If you could just answer our questions the best you can. And also, like, as I said, if you have questions for Maria, you can type them in there too, and we will be in contact with her. And Maria, thank you so much. There was so much information in this. I really appreciate you doing this for everyone. I know there are alumni on here, and there are also students on here. So I think you have a wide range of ages, and probably individual questions will be coming in. So
yeah, that's important too. When at different stages of life, you have different life goals. So yeah. Absolutely.
Yes. But it's great to see younger people on here too that are thinking of doing this already. So it's really great. So thank you, Maria, and thank you, Judy, for being here. And thank you all for attending the webinar. Once again, any questions, you can either email me or Maria or Judy, and we'll be happy to help you out. So thank you for attending, and we'll see you at the next webinar. Thank you, Maria.
Happy holidays, and Maria, Sharon, thank you very much.
Bye, everyone.